governance, which is the way organisations are managed and controlled. It's a very important topic in its own right in this syllabus, and is also important for the links with other key concepts in the syllabus, in particular internal control and audit, as we'll see. So we start off by looking at what corporate governance is, what we actually mean by this term. We'll then consider briefly why we need it. What is it about organisation that means that you have to have rules and processes and ideas in place for how they are governed and controlled? We'll then spend a little bit of time looking at the UK Corporate Governance Code of 2010. This is the best practice for UK listed companies in terms of their corporate governance. Now, it's an important point to make at the outset that CIMA will not specifically examine this code. This is a UK-specific set of guidelines. However, the code is generally taken to be best practice, and you are certainly free to use it in the exam as best practice. But as we'll see, you need to be a little bit careful how you apply it. Remember, the code, as originally drawn up, was intended to apply to UK listed companies, so for other organisations it might be applied a little bit differently. The key points of the code we're going to look at are about directors and the role of directors, and in particular there's an important role for non-executive directors in assuring control over the organisation. The code has a bit to say about directors' remuneration, how they are paid and what sort of basis they are paid on, relations with shareholders, how they actually have a dialogue with those who own the organisation, and very, very important in this paper, we'll talk about the audit committee. Listed companies under the code are required to have an audit committee, and they have a very central role in assuring the controls of the organisation. So what do we mean by corporate governance? Well, as we've already seen, it is the system by which organisations are directed and controlled. In other words, it's the high-level controls in the organisation, the controls that relate to management, how management is controlled, if you like. And what corporate governance aims to do is to make sure that companies are run in the interests of their shareholders, and possibly, depending on your view of corporate governance and the sort of organisation you're dealing with, run for the benefit of a wider group of stakeholders. Now, this is probably best explained by looking at a little bit of history. If you go back to perhaps 200 years ago, most commercial organisations were owner-managed. So if you think about most businesses at the time, whether they were farms or trading operations or something like that, if you ran a business, you probably owned it as well. And that way, you would run the business in your own best interests. You would look out for your interests. You would make sure that things were done right. Now, what happened over the 19th century and the first part of the 20th century is that there was a split developed between the owners of the business and the managers of the business. So what happened was that you had separate groups of people who were the shareholders, whether they were institutions or private investors, and the managers of the business, and in a company they are referred to as directors. So these shareholders and directors are different people. Now, in legal terms, the terms we would apply to those groups are that to say that the shareholders are the principals, it is their business, they own it, and the directors are the agents. So the directors legally act as agents for the shareholders. They go out and run the business so as to make the shareholders some profit. Now, in law, an agent has a duty to act in the best interests of the principal, and this applies to any agency relationship. So the agent must always do everything in the best interests of the principals. So far, so good. But what you get arising, and many people have identified this, is something called the agency problem. And what the agency problem says is that, for quite a number of reasons, these agents, these managers, these directors, might actually act in their own interests. So they might do things because they are in their own interests rather than in the best interests of the shareholders. So to take an example that has been studied quite a lot, if you're running a company and you're a director of the company and you are acting in your own best interests, you might perhaps want to increase your own pay and status. What's the quickest way to increase your pay and status if you're running a company? It's to run a bigger company. If you run a bigger company, you'll get paid more, you have higher status. So if you're running a company, what you might want to do is grow it. You might want to go out and make an acquisition, perhaps, so that you'll end up running a bigger company. This may or may not be in the best interest of the shareholders. You may or may not be running a more profitable company, which is what the shareholders care about, but you will be running a bigger company. So the temptation perhaps might be to make an acquisition that perhaps is not in the best interests of the shareholders. Now that's a simple example. It can get more complex than that, but that's the concept. It's about acting in your own interests, not the interests of the shareholders. What corporate governance is trying to do is to stop that happening. Now that's how it applies to companies. But the agency problem applies to other types of organisations as well. And it's an important point that I'll make repeatedly, that when questions on corporate governance come up in this paper, they very often focus on not-for-profit organisations rather than commercial organisations. So you can't just repeat the code. You have to really think through what's the agency issue here. And for a not-for-profit organisation, you will again have managers. You have to have someone who is running the organisation, but you don't have shareholders. You have stakeholders. And stakeholders is a concept that hopefully you'll be familiar with from your previous studies. So if you take an example of perhaps a big, complex charity like the National Trust, the National Trust has managers who run the organisation, but they have stakeholders as well. They have people who donate money to the charity. They have people who visit the charity's properties and locations. They have tenants. They have people who rent property from the trust, and perhaps farmers who work on its land. They have local residents. They actually have, and many more, they actually have a very large and complex set of stakeholders. So for someone like the National Trust, the issue is how do you make sure that these managers are running the National Trust in the best interests of these stakeholders instead of their own best interests. And once you've completed this chapter, going and having a look at the National Trust website would be an interesting way of researching how at least one not-for-profit organisation tackles the issues around corporate governance. You'll find a lot of detail there. So having gone through what corporate governance is, what sort of things would you expect to see in an organisation with poor corporate governance? And remember, these are the sorts of things you may well see in a scenario if this topic does come up. Well, in an organisation with poor corporate governance, what you see quite often is dominance by one individual. It is generally a bad thing for the management of any organisation for an individual to have too much power. It becomes too easy to abuse that power. And certainly if you think about the very famous, high-profile corporate governance scandals of the past, things like Maxwell, Enron, WorldCom, one of the common features has been a very, very dominant individual at the centre of it. The second feature you might expect to see is ignoring rules and controls. So where there are rules in place, whether they're legal or guidelines, they tend to get overridden, bypassed, ignored. Again, a feature of the major corporate governance scandals in the past. Perhaps the most obvious symptom is that you have organisations basically run for the benefit of management. What you may see happen is that management lose sight of the people for whom they should be running the organisation, whether it's shareholders for a commercial organisation, perhaps beneficiaries for a charity, perhaps the public for a public sector organisation. and focus more on what they can get out of the organisation and how they can perhaps benefit themselves. Now, one key aspect of that might be excessive pay and perks. Again, a key feature of scandals we've seen in the past. But perhaps they are paying themselves above the market rate, or above a rate that is perhaps thought to be reasonable, or perhaps there are bonus schemes in place that are excessively generous. And then another feature you may see is lack of scrutiny. So the decisions of management are not really being scrutinized and challenged by outside bodies. Now, there are a number of outside bodies that potentially could do this. One, as we'll see, is the non-executive directors. And more about that later. There may also be a lack of scrutiny by the auditors, because the auditors, external auditors, certainly from a financial point of view, should be scrutinizing the accounts. And perhaps a lack of scrutiny by stakeholders. Maybe external stakeholders should be holding management to account and aren't. So those are the situations where perhaps good corporate governance is not in place, where you may get abuses of power and you may get things going wrong. And in an exam question, you may be asked to identify these symptoms and make suggestions for how things can be improved. So you might think it's all looking pretty bad for shareholders. They're investing in a company, but management are quite likely to run things in their own interests. They're going to get ripped off. Things are going to go wrong. Well, it is possible to put controls in place to try and stop this happening. And we're going to think about that for lecture example 2. So have a go at this one. Assume that you are a potential investor in a company, and maybe you are in reality. What controls would you want to see in place to stop all this happening and avoid these problems? And why? How would they help? Now, try to keep your thinking here fairly general. Don't go into the detail here. But in general terms, what sort of things do you think might help prevent those abuses and might improve corporate governance? So, press pause, have a go at that, and then press play when you're ready to continue. Okay, so what sort of controls would you want to see? Well, as a shareholder, perhaps you want some control over who the directors are. This is where the issues are really going to stem from. These things are going to go wrong if you have people as directors who are perhaps dishonest or untrustworthy or in some other way unsuitable to be directors. So as a shareholder, you'd want some say in who they are. You'd want some control over the appointments to the board. Possibly, if you're a large shareholder, you might even want a seat on the board. Or perhaps you might want to be able to nominate someone to represent your interests. So you're going to want to have some control over who actually goes on the board. You're going to want to know that the directors are the right caliber. You're going to want to be absolutely sure they've got the skills, they've got the experience, they've got the credibility to actually run the company. And if you're not happy, then perhaps you might want to be able to get rid of them. You might want to have the power to put in place some new directors. You would probably want some sort of check on the financial data. The directors are going to be supplying to you financial data about how the company is doing. Now, as a shareholder, you must be able to trust that data. You must have confidence that the data is correct. So, as you're probably aware, what we have is a system of external audit in place. So you have auditors who are independent, who hopefully are reputable, who will come in and review the financial statements and then report back to you, the shareholder, and say, yes, we are happy that these financial statements are okay. One of the major psychological shocks with Enron was realizing that Enron had been turning out accounts year after year showing a huge profit, and actually it was all a sham. And the crisis was, can we trust audited accounts? Can we ever trust audited accounts again? Because if not, how can we know what to invest in? And the whole system of companies and public companies and stock exchanges comes into question. So it's vital that we have that check on the financial data. We saw previously that there are issues around pay and perks for directors, so we probably want some input into pay and perks. In particular, we are going to want to be able to have some input into how directors get their bonuses. Because it's fairly clear that if directors are being paid a bonus for example, growing the business, then they will focus all their efforts on growing the business. So we want to know what they're being paid on the basis of, how they're going to get their bonuses, because that's what they're going to do. And if we're not happy with what they're being asked to do, we might want to be able to change that. And finally, we might want some sort of punishments or sanctions for non-compliance. So if directors don't comply with the law or with best practice or with what we want them to do, we want there to be some sort of sanction there. We want them to be aware that there will be consequences if they don't follow these things. Now, this is an open question. There may be other things we want, but that is the sorts of things, I hope you can see, that we'd want to see in place. When we go on to look at the corporate governance codes, keep this big picture in mind, because this is the sort of thing that the codes are aiming at. So having looked at the big picture, let's move on to look in a little bit more detail at the UK Corporate Governance Code. Now, as discussed, the UK Corporate Governance Code sets out the principles of good practice for UK listed companies. That is a really important point that I will repeat. It applies to UK listed companies. Now, if in the exam, as is quite possible, you get a scenario relating to a not-for-profit organisation or a company that is not based in the UK, please don't just repeat the provisions of the code as if they were binding, because they're not. However, in those situations, what you will be expected to do is think about the principles behind the code and think, okay, well, how can the principles behind the code apply to this organisation to help improve corporate governance? So don't focus here on the details of the rules, focus on the principles. The code, in a very British way, does not have legal force. It is not law. It is issued by the Financial Reporting Council. In fact, companies don't even need to comply if they don't want to. There is a principle called comply or explain. And if a company feels, for whatever reason, that in their particular circumstance they should be deviating from the code, they can do so. What they are expected to do in those situations is explain to their shareholders the fact that they are deviating from the code and why and what they are doing. So they need to tell their shareholders. It's then up to the shareholders to judge whether they think that's okay. Now, having said that, the code does set the expectations that shareholders will have. It does have moral force, and most companies will not deviate from the code unless they do have a really good reason. The code talks a lot about the duties of directors, as we will see, but it also talks a bit about the responsibility of shareholders. So shareholders have a responsibility to hold the directors to account and to exercise their powers. It's not entirely a one-way street. And the diagram summarizes the key points of the code. Remember, we are thinking principles here. We're thinking what is it that can be applied to a wide range of organizations. The code says that the board is responsible for the success of the company, so they can't delegate this. They can't point to anyone else and say it's up to them to make the company successful. It is down to the board. Importantly, for our purposes in this paper, the board is absolutely responsible for determining the willingness to take risks. Remember, that is what we called risk appetite in the previous chapter. So it's down to the board to determine risk appetite. They need to review their own effectiveness, so they need to do some sort of review of whether they are performing well. Now, clearly it's very easy for a board of directors to sit around and say, yes, we're doing brilliantly. So the code does state that you should get some external facilitation, you should get some outsiders involved from time to time, at least every 3 years. So the board needs to hold itself to account, needs to think about, are they doing a good job? If not, how can they improve things? They are subject to re-election every year. Now remember, so this is by shareholders. Remember, one of the things we said shareholders would want in terms of the business is an ability to get rid of directors they didn't like, big say in who is actually on the board. Well, the code says every year they have to go back to the shareholders for reapproval, and the shareholders have the opportunity to get rid of them if they don't like them. Now, having said that, in practice it's unlikely, but the sanction is there if needed. The directors are expected to have a dialogue with their shareholders, to communicate with them openly, freely, and keep them informed of what's going on. The directors, more on this later, but the directors are also expected to review the controls in the organisation every year. So at least once a year they need to sit down and basically go through something like the risk management cycle. So they need to think about the risks that they face, need to think about whether the controls they have in place are adequate. And they are responsible for their own professional development. So directors, if they don't have the right skills and experience to do the job, either they need to step down and bring in someone else who does, or they need to find some training, do some reading, gain some experience, whatever it is they need. Now, this is an example of the sort of point that can be very generic. So a director of a public company needs perhaps some industry expertise and knowledge, but if you were the director of, for example, a charity, it might be that you're not from a charity background, but you need to understand charity law and compliance procedures. So it's your responsibility in that situation to perhaps go on a course or do some reading around charity law and make sure that you are competent to do the job that you're being asked to do. Now, the code talks about 4 categories of directors who have distinctive roles in the running of the organisation. You have executive directors who, as their name suggests, execute strategy. They execute the operations of the business. They have operational responsibility, and that can be operational responsibility perhaps for a function such as the finance director or the marketing director, or it may be operational responsibility for a division, perhaps a product division or a European division or something like that. They are expected to have a strong presence on the board. They are expected to contribute to the decision making of the board. You will also have a chief executive who, in the words of the code, runs the business. So the chief executive is responsible for overall for all operational matters. The executive directors report into them. Everything to do with the day-to-day running of the business ultimately is the responsibility of the chief executive. You also have a chairman who, in the words of the code, runs the board. The chairman doesn't have any day-to-day operational responsibilities. They are not expected to get involved in the actual running of the business. What they are expected to do is chair the board meetings. So they will run the board meetings, they will make sure that the board meetings are effective, make sure that there's good decision making taking place, that everyone gets a chance to contribute to the discussions and so forth. They will also have responsibility for liaising with directors. So they will make sure that the directors have all the information they need for the board meetings, make sure that the directors have considered their own professional development, make sure that the directors are in a good position to contribute to discussions. Quite often, they sometimes have a role liaising externally as well. So if shareholders, for example, have an issue with the company, they may well go and talk to the chairman, because the chairman is a little bit detached from the company, can perhaps take a more independent, detached view. Now, the relationship between chief executive and chairman, as you can see, is a very important one in organisations. It's important that they can work well together, but it's also important they can be independent of each other. And the code is very clear that these are 2 distinct roles and that they must be kept separate. So the code does not permit the same person to be chief executive and chairman of an organisation. Partly because they're different roles, you need different focus, partly because that means one person has too much dominance. If one person is running the business and is chairing the board meetings and is controlling the flow of information to the board, then that is too much dominance on one person. The separation goes so far that the code actually discourages retiring chief executives from becoming chairman. So it used to be fairly common that when a chief executive retired, they became chairman for a few years. The code says, well, actually, that may not be a good idea because you're not a very independent person. If you used to be chief exec, you're not going to be able to take an independent, detached view. You're always going to be looking over your successor's shoulder. And then finally, you have non-executive directors who've been the subject of a great deal of discussion in recent years. The non-executive directors are there to scrutinize and challenge the decisions of the executive directors and bring an external view to these discussions. So non-executive directors, according to the code, must be independent. They must not have strong connections to the company. So, for example, they're not allowed to have worked for the company within the last 5 years. They're not allowed to be major shareholders in the company. They're not actually allowed to be on the board for more than 9 years, because the view is that after 9 years, it's all become a bit too cozy and you've become a bit too close to the executive directors. The rules aren't that critical, as I mentioned before, but the principle is very, very important. You need to be independent. You need to be a bit of an outsider so that you can actually challenge what's going on. You're not allowed to just have 1 or 2 non-execs, because that way they're not going to have any impact. Code says that for companies over a certain size, at least half the board must be non-executive directors. There's got to be enough of them there to make a difference and really contribute to discussions. And they are expected to provide what the code calls constructive challenge. So it's not meant to be an adversarial situation, constant rows. That would be very dysfunctional. The board wouldn't be able to run the organisation. But they are expected to challenge what's going on. Now, the non-executive directors make up 2 very, very important subcommittees of the board. Firstly, and most important for this paper, they make up the audit committee. We're going to come back to the audit committee later on, but for the time being it's worth being aware that it's there and the fundamentals of what their role is. The audit committee review all the financial statements put out by the company to make sure that they're accurate and not misleading. The audit committee has quite a big role in financial matters, to the extent that the chair of the audit committee actually has to be someone with recent relevant financial experience. You've got to have someone who's got the proper expertise to do this job. They also take primary responsibility for reviewing the controls of the organisation, making sure the controls are accurate. Now, the audit committee, remember, are board members. They're non-executive directors, so they're not hands-on involved in the operations of the business, but it's up to them to make sure that the controls are effective. So that might involve interviewing managers, it might involve dealing with the auditors, or whatever other procedures they need to carry out. The audit committee also, again more on this later, oversees the internal audit function, because the internal audit function needs to be independent of management, needs to be independent of the day-to-day operations. So ultimately they're accountable to the audit committee. They also undertake the main liaison with the external auditors, for the same reason, that it brings independence to the relationship. The external auditors can deal in the first instance with the audit committee if they have issues or concerns to raise. The non-executive directors also make up the Remuneration Committee. Now, as the name implies, the Remuneration Committee determine pay and benefits for the executive directors, and the principle here is that pay should be sufficient, so you want to pay well enough to attract good people, but not excessive. It also needs to be linked to performance. So we're trying to get away from a situation where the directors sit around a table at the end of the year and say, we've done very well, we're going to give ourselves a bonus. There needs to be a much more clear and transparent link to how the company has performed. It needs to be aligned to the long-term interest risk policies and systems of the organisation. There has been a view in the past that perhaps the pay structures of directors have encouraged them to take excessive risks, trying to maximise short-term profit, perhaps at the benefit of the long term. So it's down to the Remuneration Committee to make sure that isn't happening, to make sure that pay awards are based over the long term. And it also needs to be transparent, and a set of accounts will disclose in huge detail how the directors are being paid and how much they're being paid. The final board subcommittee that you need to be aware of, that the code requires is in place, is the Nominations Committee, and as their name suggests, they control appointments to the board. This is made up partly of executive, partly of non-executive directors, and clearly this is a very important committee because who actually goes on the board will determine to a large extent how effective the board is. They are expected to have a formal, rigorous, transparent procedure. So we don't want them just appointing their friends or people they play golf with or something like that. They need to be absolutely sure they have looked widely for the best possible people to go on the board. So, for example, the code says that to make board appointments, the nominations committee must either use recruitment agents or must advertise in the press. So they must make sure they are being as open as possible about this. They're also expected to make appointments on merit, but with due regard for the benefits of diversity. Now, if you think back to your E2 studies, there's a lot in there about teamwork and groupthink and what makes a good team. And I think most people accept that if you have a mix of people from different backgrounds, and the code specifically mentions different genders, you are likely to get better discussion, different perspectives, and ultimately better decisions. So the nominations committee is expected to take that into account when making their appointments. Now, looking at a topic like corporate governance in abstract can be a bit dry. So there are a couple of things I'd recommend you do to bring this to life a bit. Firstly, I'd recommend that you go to the website of the Financial Reporting Council and download a copy of the UK Corporate Governance Code. This will allow you to see at first hand what the code really says and what it's all about. You absolutely don't have to memorize it or read it in detail, but I would recommend having a read through the code just to get a feel for what it's about. What you'll notice when you look through the code, after some of the preamble and some of the reasons why the code has taken the form it does, is a collection of principles. Now remember, what I said was important about corporate governance is the principles rather than the detailed rules. So you'll find lists of principles around leadership. So for example, you have an effective board that's collectively responsible for the success of the company. You have principles around effectiveness, around accountability, remuneration, and relations with shareholders. So that's it. That's the collection of principles that actually make up the code. What the code then goes on to do is set out a main principle and then what the code calls supporting principles. And the supporting principles go into a bit more detail and sometimes get a bit more prescriptive about what should be done. So, for example, you have a principle that the board is responsible for the success of the organisation and needs to operate effectively, and some of the detailed guidance is that the annual report needs a statement of how the board operates, which types of decisions are to be taken by the board. So then it becomes an actual provision. That is something the company must do to comply with the code. But the only reason the company needs to include this in their annual report is because they need to demonstrate that the board is operating effectively. So have a read through the code for yourself, and then you'll get a really good feel for what it's about and what sort of approach it takes. The second thing I would recommend you do is to get hold of a set of accounts of a company that you have some sort of interest in or that you're aware of. Now this could be the company you work for, if you work for a UK listed company, or a company that you're a customer of, or have a friend who works for, or anything like that. And then have a look through their annual report and see where the principles of corporate governance are shown. See what sort of disclosures they're making and see how it works in real life. Now, just to demonstrate this, I've chosen an example of the annual report of HSBC Holdings. I've chosen that for a few reasons. Firstly, HSBC is one of the biggest and best known companies in the UK. It's a big, complex operation. Its annual report runs to over 500 pages. It's the longest annual report in UK reporting history, and it goes into a lot of detail on issues around corporate governance and risk. So you can see things happening in practice that we've talked about in abstract. I'm just going to pick out a few bits from their report to show you the sorts of things I mean. So we said that one key principle of corporate governance is that you have effective directors who are the right caliber, have the experience and credibility to run the organisation. And every company needs to disclose who their directors are, and we'll give you a little bit of a bio to show that they are the right people to be in charge. So for HSBC, for example, they start off with a little bio of Stephen Green, who is the group chairman. Stephen Green's been Executive Director for a while. He was Group Chief Executive from 2003 to 2006. Now that's quite interesting, because I mentioned before that the code discourages retiring chief executives from becoming chairman, but that's exactly what's happened in this case. Stephen Green retired as chief executive, became chairman. That is contrary to the code. So how have they done it? Well, if you remember, I said that the code had a principle of comply or explain. And what HSBC have done in this case is explain. So they went to their shareholders and said, look, we know it isn't best practice for the chief executive to retire and become the chairman. However, we think in this case Stephen Green is the right person to do the job. He has loads of experience. As chairman, he's going to spend his time out there with clients and governments and so forth. He's not going to interfere in the day-to-day operations. We think he's the best man for the job. And the shareholders in this case were quite happy to go along with that. So there is provision to adapt the rules if you think that that's more appropriate for your organisation. And then talks about all the experience he's had, the businesses he's run, and generally shows that he is the right calibre of person to be chairman of the organisation. Similarly, got a profile of Michael Georgian, who's the Group Chief Executive, and some of the stuff he's done. Then goes through all the other directors. One of the ones I will pick out here, because they're a key person in terms of corporate governance, is this lady. Partly unusual for being a female director of a major company. Rona Fairhead is the chairman of the Group Audit Committee. So I said the Audit Committee, very key part of corporate governance. The person who is the chair of the Audit Committee is a very important person in terms of making sure that risk management is effective and making sure that the executive directors are being held to account. So go through her credentials: Chief Executive Officer of the Financial Times Group, board member of Pearson PLC, so again someone with a lot of experience, a lot of credibility. She is also a qualified accountant and has a lot of financial experience as well. So hopefully shareholders will feel, yes, she's a good person to be there, looking out for controls, making sure that there's a check on the executives, making sure that internal audit is running effectively, and so forth. Now, we mentioned that the directors have responsibility for setting the risk appetite of the business and also for overseeing risk management. And they do have responsibility to make disclosures to their shareholders and explain how all that is being done as well. Now, HSBC, as you can imagine, has many, many risks, lots of very complex risks, so it takes a lot of management. And they disclose in extensive detail how this works. So their risk section of their annual report, you just look at the headings here, there's a huge area covered, and it runs from page 196 to 291. So you've got about 100 pages just on detailing all the various risks that they face and how they are managed. And just looking at the headings there will give you a feel for what they are. What you'll find under each heading, just to pick some of them, is you'll find a description of what the risk actually is, and then talking about the objectives of their risk management approach, what sort of structure they have, how the risk management function works, the particular responsibilities that they carry, and generally how they go about managing this risk. So I'm not going to go through that in detail, but by all means do have a read through HSBC's report or someone similar's report to see what they actually do in practice to control the various risks that they face. Very interesting from a P3 perspective in general, as well as corporate governance in particular. Now, one of the other responsibilities of directors that we mentioned is to have a dialogue with shareholders, and again, companies are expected to report in their annual statement how that has happened and what they've been doing in order to foster dialogue with their shareholders. So you have this. You have talk about how all the directors meet with shareholders, they do analyst presentations, and then really getting quite specific about some correspondence that some of the non-executive directors have held with the institutional investors. So saying, look, we have had dialogue, guys, we have taken your views into account because this is very, very specifically what we've done. That again should reassure shareholders that their views are being taken into account. And the final section I'll touch on here is remuneration, because remember that's the responsibility of the Remuneration Committee, who have to set fair pay and also have to disclose this to the shareholders. So what you'll find in annual reports is a fairly detailed directors' remuneration report. And HSBC's, as we'll see here, talks about the Remuneration Committee, talks about what their remit is, who is actually on the committee, how they met, and then sets out the overall principles, the philosophy that underlines how they pay directors. So this has been thought about and set out in some detail. Just interesting to note in passing that they use the balanced scorecard framework. So they're using a whole range of financial and non-financial measures in order to reward directors. They focus on variable pay differentiated by performance. So what they're saying is that they have taken on board the fact that directors' pay really needs to be aligned with the long-term performance of the business and so forth. So quite a lot of detail on that, including the sort of benchmarks that they use to pay directors, and then gets the really interesting bit, how much they were actually paid. And the executive directors paid various amounts, salary and bonuses, although some of the senior management didn't actually take their bonus because of some of the troubles in the industry. And also worth noting that the non-executive directors are not paid bonuses, they are paid fees, and this again is to safeguard their independence. So they are simply paid a day rate, kind of like a consultant, for their time, for turning up and being involved in HSBC's business, but in order to keep their independence they're going to be paid the same, whatever happens. So there's a lot more in there that I'm not going to go through now, but I really do encourage you to have a look through some sets of accounts for yourselves and see how this works in action. Perhaps think about whether the organisation you're looking at does have good corporate governance and whether there are any changes you might want to make to what they're doing. Now that's all looking at the code and how it applies to listed companies. But remember, scenario-based questions quite often won't be based around UK listed companies. They may be around a completely different organisation. So the next lecture example is a very important exercise. Taking all we've talked about with the principles of corporate governance, how would they be applied, let's say, to a public sector hospital? In some ways you might think there is no organisation that's more different to something like HSBC than a public sector hospital. How is it going to be relevant? But think this through. Think through the principles of the code and think about how they could help the effective running of a hospital. Press pause, have a go at this one, and then press play when you're ready for the debrief. Okay, so hopefully thinking through that exercise, you realise that most of the principles of the code could be applied to a hospital to ensure its effective running. So, to take one example, if you talk about not allowing one person to dominate, that principle is equally true for a hospital as it would be for a commercial organisation. It is not a good idea for the running of a hospital for one person to be making all the decisions, because there's a risk that they will make some bad decisions, or maybe even abuse their power. So you're going to want checks on that. You're going to want checks on allowing one person to dominate. Quite possibly, you are going to want to split the chief executive and chairman. So you have a chief executive of the hospital who is responsible for all the day-to-day operations, and then you have a separate chairman who chairs the board. Usually it is a board of directors in a hospital, and makes sure that the board is being run properly, makes sure that governance is effective. That is a different thing to actually the day-to-day running of the hospital. You will want to have the right directors on board. It will be extremely important that they are the right calibre, they have the right skills and experience. So the nominations committee, or its equivalent, will have a very, very important job to do. You're going to want a bit of a mix, perhaps, of clinical experience, people who are medically qualified and medically expert, with those who are experts in management, because that is a completely different skill set. You're going to need to get a mix between the two. You're also going to have some provision for removal of directors who aren't the right calibre, or who aren't up to scratch, And that could be quite tricky. That could depend on what sort of government supervision you have in place, but ideally you would want to see it there. You'll also want reasonable pay. If you're a public sector hospital, you are accountable to taxpayers who are ultimately footing the bill. So you don't want to be paying excessively. On the other hand, you want to have good people in charge of the hospital so that it's run effectively. So you've got to be paying well enough to attract those good people. There needs to be a mechanism in place for you to determine that. You will also need to have dialogue. Now, clearly you don't have shareholders in a hospital, but you will want dialogue with stakeholders. So the board of directors will need to be talking to some of the key stakeholder groups, which will include staff, which will include patients, will include probably the local community who may be patients at some point, and will also undoubtedly include government, because government bodies will be funding and probably the regulators as well. So the board of directors will need to show how they are consulting with those stakeholder groups and how they are taking their views into account. It may well be that representatives from these groups actually want a seat on the board. Maybe there should be someone on the board who is a representative of patient groups, someone perhaps from a government body, or staff representatives. So maybe they should actually sit on the board, but even if they don't, their views need to be taken into account. So hopefully you can see the principles are very, very relevant, and that if you understand those principles, you can apply them to any type of organisation and work out how they can improve governance and help the organisation to run more effectively. Now, so far we've talked about the UK approach to corporate governance. And remember, it's not going to be examined specifically, but you are free to use that as best practice and draw on it for recommendations when applying to any organisation that you're given in the exam in a scenario. However, it is worth touching on the US approach to corporate governance because it is very different in some respects, and it's worth being aware there are other approaches out there and how they differ. Now, the US approach to corporate governance centres around the Sarbanes-Oxley Act of 2002, which was passed shortly after the whole Enron affair and other similar scandals, and was very much aimed at making sure they don't happen again. Now, in fact, in some respects, some of its provisions and some of its principles are quite similar to the UK code, but there are some key differences as well. For one thing, it is an act. It is actually set out in law. The UK code is guidelines. You are, as we've seen, free to apply them or not apply them, and they don't have any legal force. The US approach is law, so you simply have to do it. There aren't any options. There is no comply or explain. The US approach goes further than the UK in limiting non-audit work that external auditors can do for their clients. One of the issues with Enron was that Arthur Andersen, who were their auditors, were also doing a large amount of consulting work for them. So Andersen were very reluctant to challenge some of the rather strange things that Enron were doing with their accounts. So the Sarbanes-Oxley Act says fundamentally that you can't do that. In most circumstances, if you're auditing a company, you are not allowed to do consulting work as well. So that way you don't have a conflict of interests. Under the Sarbanes-Oxley Act, management need to assess the effectiveness of internal controls. That is actually the same in the UK, but the difference is that in the US, the external auditors actually report on the assessment. So the external auditors in the US will actually report on how effective they think the controls in a company are. They will also assess on whether they think management have made a good assessment. So the auditors getting much, much more involved in the whole controls issue. That does not happen in the UK. In the UK, auditors do not have responsibility for doing that. In the US, companies are required to adopt a code of ethics so that there is something formal to say how people should be behaving. And probably the most eye-catching provision of the Sarbanes-Oxley Act, which was intended to be eye-catching, it was intended to focus the minds of senior people, is that the chief executive officers and the chief financial officers must personally sign off to say that the accounts are appropriate and presented fairly. If they do not, if they sign off negligently or fraudulently, they can actually be punished by up to 20 years in prison as well as a significant fine. So there is absolutely no evading responsibility for the accounts. Now clearly this means that chief executives and chief financial officers are going to be very, very focused on making sure that the accounts and the controls are right. So that was what it was intended to do. And then finally, there is a new independent regulator to oversee auditors. Up until the Sarbanes-Oxley Act, the audit profession in the US, as in the UK, had been largely self-regulating, but the failure of Arthur Andersen was felt to be so dramatic that that wasn't good enough, so in future this was put under independent regulation. It's worth being aware you may come across the Sarbanes-Oxley Act provisions in the UK quite extensively because it applies to all companies that are quoted on a US stock exchange. So it might apply to companies outside the US either if they are owned by a US company or if they have a listing on a US stock exchange. So companies like, for example, HSBC or Shell or UBS or other major European companies also have a US listing. That means they are subject to the Sarbanes-Oxley Act. So worth just being aware of the key points of differences so that you do know there are different approaches out there, and you can draw on the Sarbanes-Oxley Act, if you like, as another example of international good practice. So just to summarise then, we looked at what corporate governance actually is. It is the system by which organisations are directed and controlled. That includes all organisations, whether they are for-profit, not-for-profit, government, or whatever they are, or wherever they're based. What it's trying to do is protect the interests of shareholders and stakeholders, trying to make sure that organisations are run for their benefit and not run just for the benefit of management. In the UK, the approach to corporate governance is contained in the UK Corporate Governance Code. So what it focuses on in particular, directors remuneration, the dialogue with shareholders, and sitting at the heart of it, the audit committee that is made up entirely of non-executive directors has responsibility for audit and also the review of controls. It applies to UK listed companies, but remember you are free to use it as best practice for other types of organisations, but please make sure that you are taking a principles-based approach, that you're thinking about the principles of the code and how they might apply to a different organisation. Don't just assume that the detailed rules in the code will apply to other types of organisations. The US approach is quite different. There's statutory and is contained in the Sarbanes-Oxley Act, or SARBOX, and this is a much more prescriptive, rules-based approach than you find in the UK, even though many of the principles behind it, and certainly the purpose behind it, to protect shareholders and stakeholders, are very similar.